Hey guys, Michelle Kinney here. Thanks for checking in. Thanks for checking out my video. I am going to show you in this video how you can trade Google for 500 bucks, right? Do you have $500? Have you been wanting to trade Google, but you can't afford it? I'm going to show you how. Check this. I'm going to go ahead and share my screen. Okay. So give me a second here. First, I'm going to pull up a trading platform, right? So I am going to pull up E-Trade. So it works for any platform, but basically, it's a lot of information on the screen, but I'm going to break it down into easy to understand bite-sized pieces, right? So here's your stock right here, right? Alphabet. So that's Google, right? So right now, obviously the market's closed right now. It's 5 o'clock Pacific time. So the market closes at 4 Eastern. So it's been closed a few hours, but here's where it's trading at the moment. And we're going to look at some ideas and look to do something perhaps for tomorrow. So right now it's $2,778 per share, right? You guys see that per share? Now, I mean, you could buy one share of Google. You could probably buy like a tenth of a share of Google, like on Robinhood or something like that. Let's say if you wanted to buy 100 shares of Google though, right? 100 times 2778. Holy cow, that's $277,000, right? So maybe you like Google, maybe you're favorable and you're bullish on Google. You think Google's going to go up because Google is an amazing company and you want to trade it, but you don't have enough money. But I'm going to show you how in this video, right? You don't need $277,000 to buy 100 shares. Let me show you. First, we always start looking at a chart, right? When we're going to trade something. So here's Google. Here's a chart. This is going to be a 1-year chart. We're going to look at a 1-year chart first, okay? So this is kind of like where Google has been in the past year. So it was as low as, I don't know, like 1,400 bucks. And right now it's 2,700. So it's almost doubled in price in the past year, right? So there's lots of different ways that you can trade and make money. You can buy stock, and when the stock goes up, you can make money. You can think maybe the stock's going to go down, and you can short a stock, sell a stock short, and if the price goes down, you make money, right? You can buy a call, and if the price goes up, you can make money. You can sell a put, and if the price goes up, you can make money. You can also do what I'm going to show you here, which is trade a credit spread and make money. Let me show you what I'm talking about. Okay, so here's our chart. So right now, Google is 2778. I'm going to pull up my options chain, right? Options chains are just where the options are trading. And again, this is like a lot of information. It can be as easy as you make it, or it can be as challenging as you make it. I'm going to make it super easy for you. So I'm going to point out, like I'm going to give you always the Cliff Notes version. I'm going to point out what's important for you to look at. Here's the strike prices. These are the prices at which you would need to buy or sell a stock if you're trading an option, right? Now, we always sell options. We're going to trade a credit spread, meaning we're going to take in premium. Why? Because we want to be like an insurance company. We want to like calculate the likelihood of something happening, and we want to take in income. And let me show you what I'm talking about. Let's look at Delta. Delta is kind of like the cheat sheet way that we can look at like the statistical likelihood that a stock's going to go from where it's trading now to the strike price between now and the expiration date. So let's look at like a 10 delta. I don't know. Let's look at just a regular nice round number, 10, right? So 10, what that means is let's kind of go across this, right? So here's a 10 delta. That's 0.1035. It's approximately 10% likelihood that Google is going to go from 2778 to 2705 between now and this Friday, which is the expiration date of the contract that I'm looking at, right? So it's very, very low likelihood, 10%, right? So I can do one thing. I can sell a credit spread, trade a credit spread. I'm going to show you how. So I'm going to sell a 2705 put. So let me put that in my spreadsheet here, and I'm going to put Google. Today is what? Today's the 16th of August, but I'm going to pretend it's the 17th because the market's closed right now, okay? So we can't make a trade at the moment. You can't trade options after the market's closed. And I'm going to look at 820. These are spreadsheets that I create. I always, I'm not a spreadsheet guru, but, spreadsheets are very handy because they kind of help you understand what your risk is and how much return that you have the potential of making and things like that. So it's kind of cool. If you belong to part of my group, I have an options trading group. It's super cool. Man, a couple weeks ago, last week or the week before, we went to my house in the Virgin Islands, a few of us. So I live in LA, and some of the people in my group, they're from kind of all over the place. So a few of us went to my place in the Virgin Islands and we traded together. Oh my gosh, it was so much fun. We took a boat trip together. We went swimming together. We hung out. It was cool. I don't even know where I was going with that. Anyway, let's say I want to sell this put. I'm going to put in a 2705. Oh, where I was going with that. I provide these spreadsheets to the people in my group. So that's my purpose, my point I was trying to make. So bid ask, I'm going to ignore that in the interest of time. And I'm going to say, okay, the last trade for this was 3.4. See the last column? So that means the last trade, somebody bought a 2705 option and somebody sold the 2705 option before the market closed today. And the price was 3.4, right? So I'm going to put that price here. So in the interest of time, I'm just going to put that there. Okay. I'm going to sell a 2705 and then I'm going to buy a 2700 option. And I'm going to go over what that means in a moment. And the last trade for 2700 was 2.82. Okay. I'm going to copy some of my fields right here. Control C, Control V. I'm going to copy this and I'm going to copy this. Holy cow, is that number correct? Wait, that can't be correct. Holy cow. Let's see. I have to adjust some of my fields here. Hang on a second. I'm going to stop the recording for a moment here. And give me 1 second. Oh, you know what I did? I know what I did. Let me share my screen again. Sorry about that. I put the number in the wrong box. Sorry. So this is actually 282 over here. And then this is this over here. Sorry about that. Holy cow. Okay, let me walk through this with you. Check it. So I'm going to start from the top. And then you hit me up afterward. I know this is a recording, but if you have questions after, you let me know. You can put a post here. You can contact me via social media, lots of different ways. Google is 2778. I like Google, but I don't have a ton of money. And as a matter of fact, maybe I only have 500 bucks that I want to be able to trade, right? I want to start off small. So how can I trade Google with 500 bucks? Here's how. You can sell a 2705 put. What that means is you're going to take in, we're going to go based on last trading price. Last trade at $3.40. That's $340. That means that $340 goes into your account, right? So plus $340. There's a 10% likelihood that Google is going to go from where it is now, 2778, to 2705 between now and Friday. Not very likely, only 10% likely. At the same time we sell that put, we want to define our risk. We want to limit our risk, right? The market is a scary place. You can lose some of your money. You can lose all of your money. So we want to be protecting. We want to put a helmet on. We want to put a seatbelt on. We want to use protection. I'm going to buy a 2700 put. I'm going to sell a 2705. And I'm going to protect myself and buy a 2700 put. I'm going to hedge myself. So for selling one put, I'm going to take in $340. And for buying the other put, I'm going to pay $282, right? When we buy a put, we pay a premium. When we sell a put, we collect a premium. I have other videos that go over that. Okay, if you're interested, just look on this channel. There's going to be tons of other videos, but just stay with me for now. I have this spreadsheet, right? I'm going to take in $340. I'm going to pay out $228. I'm going to get a credit of $110. That's the difference between the two, right? Let me just pull up a calculator and show you guys. $340 I'm going to receive for the put that I sell. $228 is the price I'm going to pay. Now it's like there's some commission involved. So I'm actually going to net $108. I'm just going to round this off. I'm not going to use cents. I'm going to net $108. What that means is $108 is going to go in my pocket, right? The most that I can lose on this trade if it goes south, right? so to speak, if the trade goes south, if it goes against me, is $500. When you trade a credit spread, you can only maximum, right? The maximum you can lose is the difference between the two strikes. So if I'm selling a 2705 put and I'm buying a 2700 put, what's the difference between those numbers? 5 times 100, because there's always 100 shares in a contract. $500. So $500 is my maximum risk on this trade. So if the trade goes against me, the most I can lose is $500. I'm taking in $108. What does that mean? What am I making on a rate of return basis? On a rate of return basis, you're making 22%, right? You're taking in $110. Let me show you. You're taking in $108, right? 108 and change after the commission, after the transaction fee. Anytime you make a trade, you have to pay like the New York Stock Exchange $1 or $2 to make the trade. So you end up with $108 in your pocket, right? You're putting up 500. You're risking $500. In fact, you can open an account with just $500. You're making 20. Now, because of rounding, it's going to be a little bit different. So my number here is 22.1%. This is 21.6%. We're just going to say 20%, right? We're going to round it off. You're making 20%, but you're making that only for 3 days, right? Or 4 days. Let's say today's Monday, the 16th, but I'm going to put the trade in tomorrow, the 17th. I'm going to hold the trade till Friday, the 20th. I'm only holding it Tuesday, Wednesday, Thursday, Friday. I'm holding it 4 days. If I annualize my premium out and I do this once a week, you can do it once a week. You can do this kind of trade every day if you wanted to. Every day the market's open. You can make up to, on this trade, 376%. Now, I want to pause right there because sometimes people say, Michelle, stop telling people that you're going to make 100%, 200%, 300%. I'm not telling you that you're going to make 300%. I'm not telling you that you're probably going to make 300%. What I am telling you is that you can make 300%. And do people make a lot of money trading options? Yep, they do. And here's why, because of the mathematics of it. And you can limit your risk. And I'm going to say this again. So let me give you a quick snippet of my story, right? I've been trading since 1997, a long, long time ago. Back in 97, I owned a bar and grill. I had a friend of mine, David, he used to come in and he used to say, Michelle, oh my gosh, check out these commodity trades. It was old school. 1997, there were no computers, right? So it was like Investors Business Daily. I don't know if any old school people are out there, but I used to read like the newspaper. I didn't have a computer. I didn't even have anything to put it. When I put a trade in, I used to call I didn't have a cell phone. I used to call my broker in Chicago, old school, dial the phone. I did have a push button back then, but old school, put a trade in, right? So I was trading commodity futures and options. At that time, a long time ago, I didn't even know what stocks were. I didn't know what commodities were. I didn't know what options were. I didn't know what anything was, right? I always thought, when I grew up, oh my gosh, you have to work more, make more money. You have to work more. How do you make more money? I don't know. Get a different job. I don't know. Buy a business, do something different. I never knew that you can actually trade stock or trade options or, financial securities, that kind of thing. I was mesmerized. That's when I started, right? Then in 2007, I started managing money for clients. I made a lot of money for a lot of people, and then I lost a lot of money for a lot of people. You know what? Strategies are great until they're not great. Did I make mistakes over the years? Yeah, and I learned from those mistakes. I learned from tons and tons of mistakes. And if there was one biggest mistake that I remember to date, it's risk. Risk is so important. Let me tell you why. If you lose 50, I'm just going to use round numbers. If you lose 50% of your account value, you have to make 100% just to get back to where you started. How easy it is to make 100% is not that easy, right? Sometimes when it comes to options, you can what we call over leverage, right? This happened to me personally. Back before COVID, I was making tons of money. I was selling lots of puts, making a lot of money. I was over leveraged though. I wasn't really anticipating the market to go down so significantly in such a short period of time. But can things happen? Yep, they can. And did it? Yep, it did. So it taught me that it's super, super, super important to control your risk. Hence my attraction now to, let's say, credit spreads as an example. There's lots of different strategies. This is just one of them. A credit spread gives you 3 things, right? It lets you trade if you have a super small account. So you can open a brokerage account with literally $500 and you can start making trades and you can start taking in income for yourself. So you don't have to start with thousands of dollars, number one. Number two, it allows you, when you trade a credit spread, it allows you to create systematic, steady streams of income. Why? Because when we trade stock options, a lot of stock options, most of them, the ones that I do, expire every Friday. Why do I want to put trades in every Friday? You know why? Because I don't know what the market's going to do tomorrow. I don't know what's going to do tomorrow. I don't know what's going to do next week. I don't know what's going to do next month. And I don't want to subject myself to the volatility and the gyration of the stock market. So I want to lock in my income each and every single week. Let me ask you guys a question. This is a good question. This is going to be a rhetorical question for me, but it's a question for you. Do you trade stocks or options or whatever it is that you trade, your 401k? Do you trade in general? Do you do that so you can go get the mail in your mailbox outside and open your mail and say, oh my gosh, I went from X dollars to X dollars. I made X dollars. I want to see a green chart. Or you want to look online on your computer online account and you went from, let's say, I don't know, $2,000 to $2,200. Does that excite you? Maybe it excites you. This is a rhetorical question, so don't answer it. I'm going to say, does that excite you, or would it excite you perhaps a little bit more if you can create income for yourself? Why do we invest, people? We invest because we want to make money, so we go spend money with the people that we love and create experiences and do all these crazy things, right? I want to go buy, my son just started football. I had to take him to Dick's yesterday and buy like a pair of cleats and some shorts and things like that. My daughter's going to college. I have to pay her tuition bill. I'm going away this weekend to see some friends in Texas. I had to buy an airline flight. My point is, you need spendable income. The world is not about looking at a computer screen and see what your account did from day to day. No, it's about creating income for yourself so you can spend it, so you can live the lifestyle and the life that you want to, right? That's what options does for you. So let me go back to I said credit spreads do three things, right? So the second thing, it creates income. And then the third thing that it does for you, it allows you to predefine your risk. So we don't want to, like, let's say, don't make the same mistakes I made, let's say in my past, right? Where I was over leveraged and then I lost way more money than I intended to, or I thought that I could, or that sort of thing, because the market went south super quick. No, set yourself up ahead of time. There's lots of different ways. This is just one of them. There's lots of different ways to do it. So in a credit spread, you define your risk. If I'm selling a put here, I'm buying another put as protection underneath, and my risk is the difference between the two. So for example, in Google, if I'm selling a 2705 put and I'm buying a $2,700 put, the difference is five times 100, because 100 shares in a contract. The risk, my maximum risk is $500. I have predefined risk, and I know how much money I'm going to make. I'm going to make $108.63 in my fucking pocket right now, and I'm going to risk $500. Even if Google goes bankrupt or something like that, Google goes all the way down, I lose up to $500. Now, I'm going to put a big asterisk there. There's a little bit more details to this. This is like a quick snippet on, here's a good trading idea. I'm not a financial advisor. I'm not giving you investment advice. I'm not giving you a recommendation. Do your own diligence, right? Due diligence. People can and do lose money in the stock market, and there's a couple of other rules that you want to understand before you put this trade in. What I'm doing is I'm giving you conceptually how it works, right? Your maximum risk is $500. You're making $108. If there's only a 10% likelihood it's going to go down to that price, assuming that you're in that 90%, majority, you're going to make, and if you did this trade once a week, you're going to make 376% on your money. Dope. So that's my spiel, I guess, if you will. I don't know. I don't mean this to sound salesy at all, but I get super excited talking about these things. I think stock options are amazing. I was training one-on-one with somebody earlier today, Jessica. I'll give a shout out to Jessica. And her and I were talking about a few things. And I mentioned to her, and I've said this lots of times before, if you are trading stock and you are not trading options, you are missing the boat in many, many different ways. Here's just one example. There's lots of examples. Anyhow, I hope this helps. That's my thing for the day. I'm going to do a free webinar tomorrow. So today is, obviously this is going to go on YouTube. So it's recorded. Today's August 16th. I'm going to do a free webinar tomorrow on credit spreads. So I'm going to give you a little bit more information, screen sharing, that kind of thing. I'm going to put the link in the comments below. let me know if you guys have any questions, and I hope that helps.